In this video, we'll be going over the case for precious metals. I was invested in the space from May of 2019. I've done some research, not too much. I thought I'd finally make a video about it as gold is approaching its all-time high, and that might be able to draw in some interest, and I thought I'd do something to explain the case for gold. These are the topics that we'll be going over today. First up, the case for precious metals by Rick Rule, the ways to invest in the space, and also any near-term resistance. So the first big factor for the case of gold is quantitative easing, also known as QE. This is something that it essentially is just money printing. If, quoting Rick Rule, if you and I were to do it as counterfeiting, we would go to jail. But if the central bank does it, all of a sudden it's called quantitative easing. Essentially what it is just massive expansion of the central bank's balance sheet by buying up financial assets. And as you can see from after the 2008 crisis, we have a massive increase of the Federal Reserve's balance sheet. They mostly bought, U.S. Treasuries, MBS. It was a lot of loans that were guaranteed by the government, and so that was kind of their justification. It's like, oh, it's guaranteed by Congress, so it's okay for us to buy in, and balloon it all the way up to about 4.4 trillion. And they tried to shrink the balance sheet, but they failed up to 3.8 trillion before having to reverse course and go all the way back up. We saw 7 trillion a few weeks ago. They've actually tampered recently, but I'm expecting them to, restart and add a bunch more as Congress is trying to pass another stimulus bill. One thing to keep in mind is every amount that Congress right now is spending, a lot of it is actually, so every dollar additional spending right now, 60 cents is financed by the Federal Reserve. So every dollar Congress spends, 60 cents is printed. And what this does is it keeps yields low and it props up asset prices. How does it keep yields low? So what happens is in the bond market, when there's a lot of buyers, the interest rates, so the yields, goes lower. But what happens is normally it should be rising because of default or whatever. But when the central bank comes in with an unlimited printing press, it pushes yields lower. It allows for companies to continue to issue at lower rates, and also the national debt to not have such of a high financing costs. And finally, what money printing does, it is a debasement of the currency. So the second the central bank prints $1, everyone else who holds a US dollar loses a bit of its value because there's nothing actually happened. There's no productivity that was increased. All that happened was the pool of money that are used to buy goods increased. So meaning the amount that can be bought per US dollar decreases as they print more money. So let's go over artificial low interest rates. So we kind of touched on it a little bit on the last slide. So this is something that have been referenced as like part of the Greenspan put, which was done in the midst of the dot-com bubble in the 2000s, where the Federal Reserve chair back then, Alan Greenspan, was famously cut interest rates to near zero, or actually 1%, but it was cut by 500 basis points, so 5%, to help stimulate the economies. Because what happens is when interest rates are lower, borrowers are more encouraged to go out to borrow, and it helps stimulate the economy where businesses are encouraged to borrow to maybe purchase equipment, platinum equipment to increase production. But the problem is for consumers are now encouraged to go out to spend more, load up on credit card debt, load up on auto loans, etc. And what that actually did was it fueled the 2008 housing bubble, and that's why, because mortgage was such a big part, such a big amount, a few percent change in the interest rate actually has a huge impact on people's ability to purchase a much bigger price home. And so they were actually able to raise interest rate prior to the 2008 financial crisis from 1% back to 5%, from 1% back to 5%, before having to go all the way back down to zero by Ben Bernanke, the Fed chairman back then. And Jerome Powell was only able to raise it back up to, I think it was like 2.5 or 2.25 before once again reverse course in 2019 to go all the way back to zero again. And so let's do a little bit of math. For the US Treasury right now, today, we're sitting, so US 30-year Treasury has the highest yield. It's sitting at 1.25%. The Federal Reserve is telling you that they're targeting inflation at 2%. So if you were to buy a US 30-year Treasury today and you held it to maturity, you will lose 0.75% per year. This is really mind-boggling for why would anyone purchase at these levels. And something I mentioned like in a different video is that people buying at these yields aren't planning to hold till maturity. They're expecting someone else to buy it off them and they get a capital gain. And also, or interest rate moves even lower, which means negative. But Powell has already mentioned that he's not interested in that. We'll see how that goes. But real yields right now is negative. Now, the question is, how does that link back to gold? Now, gold, by definition, the idea is that gold doesn't do anything. It doesn't change. It holds its value. So it's at 0% return if you hold it. But if your money is losing value at 0.75% per year for 30 years, that means if you are to hold gold, in relative, you gain 0.75% per year just by holding gold. Obviously, like interest rate changes, and there's also cost of holding gold. The storage cost, it's usually about like 1%. But this analysis hinges on the fact that inflation is only going to be 2%. And with all the massive money printing, I'm expecting it to go a lot higher. So that means in comparison to holding cash, holding gold, you actually preserve your purchasing power much better. So finally, the last point is massive deficits and national debt. So if we look at this picture, I like this site. It's pretty cool. USDebtClock.org. It goes in depth into like the different debt and where it's coming from, mostly for the US and also like national debts around the world. I don't know how they're getting these calculations, but I think it's just programmed based on like the latest data, and it just kind of prices in every now and then. But nevertheless, it's been pretty accurate recently. So with the growing deficits and national debts, the credit quality of government issued debt is in question as a safe haven for store value. So what credit quality is the ability of borrower to repay its loan. So let's say if you imagine like a risky business, yes, maybe they're giving you an interest rate of like 7 and 8%, but there's a high chance of them going bankrupt and you won't be getting your principal back. So when you lend them like $100, maybe they will go bankrupt and you only get like 60 or 30 cents back or $30 back. And in this case, as taxes collected, so the revenues for governments decreases and the government payouts, the expenses, like the different programs, increase, the ability for the national government to repay its debts in today's dollar value decreases. Now, what does that mean in today's dollar value? So they could pay it off with like the same amount of dollars. So let's say they borrowed $100 today and they repay you $100 5 years from now. But the problem is in between, they have created a lot more dollars, meaning the $100 that you loaned them today has lost value, its purchasing power, over the period of 5 years because they have, printed a lot more other dollars. So let's do a quick recap for the case for precious metals. First up, we have QE, quantitative easing. That is the debasement of currency / purchasing power. And what that means is the central bank's continuous effort to steal purchasing power away from you when they print an extra dollar and give it to someone else. So this is kind of like taxation, but taxation is more of the honest way to do it, where government takes your money through taxes and they give it to someone else. But in quantitative easing, instead of taking your money, they take the purchasing power of your money. When they print an extra dollar, and someone else use that dollar to buy a good, that's some good that you could have purchased. If the number of goods do not increase, but the number of currency increase that's able to purchase those goods, the prices will rise. Next up, we have artificial low interest rates. This reduces the cost of holding precious metals. So for example, if interest rates was at 5%, inflation at 2%, this is, let's say, like a term deposit or something. Then by putting your money into the term deposit, you net out 3% because 5% nominal, 2% inflation. 5 minus 2, 3. Comparing to holding gold, 0%, doesn't do anything. And so your opportunity cost to hold gold is 3% because you lose out 3% that you otherwise would have gotten. But when interest rates are so low to the point where real rates are negative right now, what happens is you're essentially getting paid to hold gold in comparison to holding cash, because gold is being steady, but holding cash is you lose value to inflation. Finally, we have massive deficit in national debt. This reduces the quality of government-issued debt, and government-issued debt is usually known as like risk-free, safe haven. But as the credit quality is now in question, they lose that status, and that could be a driver to push people in search of safe havens into precious metals. And it is also, with the massive deficit in national debt, it is more incentives for the central banks to keep QE going and low interest rate. As the debt grow bigger, in order to finance those debts for the interest payments, by lowering interest rates, it helps to lower the interest rate costs, and by printing more money also to inflate the debt away. Now let's take a look at the ways to invest. For physical, you can definitely purchase physical gold and silver. You can either store it yourself, or you can put it into storage units, or you can put it into safety deposit box. But something that some people are concerned about is the government's will to come down and confiscate them, as they have done in the past. And that's why they're saying, hey, don't keep it there. So you can definitely do it, have physical that way. For ETFs, you can also keep physical through the physical trusts, where they hold it in their various areas, where you purchase one share of their ETF, and you have a specific claim to the pool of precious metals. For stocks, same thing. It's an ETF that has a pool of assets of stocks, and you can buy and sell these ETFs. And the interesting part of these comparing to mutual funds is that you can buy and sell throughout the day. Obviously, there's still management fees attached to it. For mutual funds, the only difference is you can't really buy and sell throughout the day. But same thing, it does the same function as an ETF for stocks. If you don't want to spend the time to take a look at the specific stocks, and you just want to be exposed to this sector. For equities, you will have your seniors, intermediate, juniors, and royalties. Royalties is pretty interesting in this space, where the cost is very similar. It's very stable, but the revenue is greatly impacted by the increase in precious metal prices. Their asset utilization rates is one of the highest ones in terms of revenue per capex. For the rest, for seniors, intermediate, and juniors, the seniors usually move first, and then intermediate, and then juniors, but the juniors moving last will move the furthest, obviously on the ones that actually have gold, because in juniors there's a lot of just shell companies, exploration, they might not find any gold. So if you are to participate in the space, when you go further along in the quality train ladder, you really need to make sure you do your own research and you're prepared to potentially lose some money or all. Finally, we have certificates or futures. These are kind of known as paper gold. A certificate, a gold certificate, is something that you can purchase like from a bank, saying like, hey, maybe you own like an ounce of gold. But the problem with these are, or sorry, going into futures, that's if you're going into the COMEX, you can buy a contract for a delivery of gold. You can get it delivered, or you can sell the contract or roll it forward. But the problem with these is you don't know if that counterparty actually has the physical, and that's something that has come up for the banks in terms of the COMEX, where I saw an article the other day where for every dollar increase in gold, the big banks are losing 248.8 million because they're the main shorters of the market. Finally, let's take a look at near-term resistance. So recently, for the past 5 days, there's a really impressive rally with gold up 5%. At the time of this recording is at 1892. It's approaching its all-time high of 1920. It's September 2011. Silver up a whopping 20% with all-time high not until about 50 bucks. Silver, for gold, a lot of experts are saying like there will be a pretty big resistance around this level due to the all-time high, and a lot of people want to get out like finally as they got in around September 2011. Silver has a lot more room to run. Silver usually lags gold in a precious metals bull market, so this could be a great indicator that we're about to see a lot more explosive moves. And silver, in terms of long-term outlook, I'm a lot more bullish, not only because the relation to gold, as we can see in the gold-silver ratio, it's sitting at about above 80, finally broke down from the high of 120 from March. But if you actually take a look at how much silver is mined per gold, because silver is usually mined as a byproduct, but not necessarily as a primary objective. And I think it's about 12 ounce to gold. So every 1 ounce of gold you can mine like 12 ounces of silver. And for the Western countries, they are focused more on gold, where China is actually more focused on silver. So the gold-silver ratio in the Western countries are about like on the average is 70 to 80, where in China it's actually it's actually between 20. And so as China is able to gain more power in the global stage, we could see gold and silver ratio to approach their level or their desired level. And in terms of condition for gold, in 2011, the conditions comparing to now, the conditions now are much worse in terms of the debt to GDP, a lot more national debt, household debt, and corporate debt. And in terms of the policies that are being enacted on the topics that I discussed before, like QE and deficits and interest rates, that these are the reasons why I believe long term, there's no doubt in my mind we will pierce through the all-time high and go much further. How much further, that really depends how much more stimulus global governments would like to do. In the very short term, however, we might see a slight pullback along with the general market, as just like what happened in March, but I don't expect us to fall back to that level, as quantitative easing has already begun. David Brady is expecting this to occur within a week or two, and he calls it the last great buying opportunity.